Hello and welcome again to the New Traders Playbook. This is episode 4, and today we're going to be talking all about gaps and the strat. So if you have ever taken any look into the market, maybe you've dug a little bit into how learning to trade is, you probably have come across some of these concepts, but today we're going to make them really easy to understand and visualize so that you can now go into your charts and see why is price doing what it is doing. So let's get started here. Let's take a look at something that we've been talking about recently. We've been talking about the structures of the candles. We know that with a bearish red candle, obviously we're going to have our open, then we're going to have our high, then it's going to come down to the low, and then it's going to make a close. In the next candle, which is also bearish, we're going to have our open right here. Now, oftentimes, not always, we'll talk a little bit more about that later, but oftentimes one candle, for example, this bearish candle, the close of this candle should usually equal the open of this next candle. Obviously, because when that time frame ends, this one begins, which is why usually you are going to see the close and the open represented by really the same level. Down here, the price is going to go open, high, low, close. Then it's going to go open, then it's going to get a high, then it's going to go all the way down to the low and then close right there. Okay, we have 3 bearish candles in a row. Now, what we're talking a little bit about today is something a twinge different that I think is important. So take a look at this area right here. What do we have right here? We have an area that doesn't have any wicks in it. Okay, so what we're going to consider this as is when price went from this candle's low to this candle's high, and there was nothing there. There were no wicks in between that area. So usually from a low to a high, 2 candles apart, or vice versa, a high to a low. This is what we usually call well, it really does depend on who you're listening to, but there are a lot of different names for it. In this series, we're just going to call them gaps, but usually you're also going to see them called fair value gaps or FVGs. So if you ever see the expression FVG, that's what this is, a fair value gap. A gap just means that price was going very quickly at some point and it didn't really write back over itself. And we're going to kind of take a look at what that looks like here in a second. But the gap is essentially price didn't close, didn't continue, didn't rewrite over an area that is in the middle. So just remember, it has everything to do with the previous candle's low, in this case, and the following candle's high. These 2 things right here create this fair value gap. Now, let's take a little bit deeper look into what that actually means, because it's really, really important that we understand that it's all about unfinished business. Now, in the first episode, we talked about painting, right? So when we have a paintbrush, we go up and down and up and down. And if we're painting on a wall, then that means we have to show that we have to go up and down, and then the paint has to actually go across all the spaces. Now, if I only do one line of painting, it might not be thick enough, so I may have to go back over it. So let's take a little look at what we've created here. So here's the high. Now we're looking at bullish candles. There's the high of this candle, and here's the low of this candle. Once again, we have in the middle our fair value gap, or just our gap, right? Okay, so why does that matter? Well, let's talk about what actually happened while price was making its moves inside of these candles. So initially, price came in this candle and it started right here, right in that spot. And then price went down and it came back up to the high and then it closed. Okay, cool. Now what about this candle? Well, for the most part, there's your open, right? So price went down and then it went all the way up to the top and then it came back and it settled right here at the close. Fantastic. Third candle, price starts right there on the open, as we've talked about, and it goes down, and then it goes up, and then it comes and it closes. Okay, fantastic. So we have essentially the structure of each candle as it was built. Now let's take each one of these and let's move them over to see exactly what is happening. Let's move them to the spaces where they are, where each one starts. Fantastic. So there's something interesting here that you need to understand when price makes these kinds of moves. And what that is there's a difference between balanced and unbalanced price. So let's take a look at this first area right here. What is happening here? Let's change our colors up a little bit. Inside of this box, we had 1, 2, 3, 4 times that price ran over this specific area. Fantastic. We're balancing things. Now let's take a look at another side up here. 1, 2, 3, 4. So in both of these cases, you're noticing that price has decided that it is balanced because think of it like the paint. We've taken the brush up, down, and now that area of a wall has been appropriately painted, and we can move on to the next area. But with that in mind, what has happened right here? Well, in this space, you'll notice we only have one quote unquote brush stroke. What do we mean? What does that usually look like? Well, essentially it looks unbalanced. Okay. So if we have unbalanced price, that's telling us that something is missing right here. Something didn't happen. Usually what it means is that price took a little bit of time in this area, kind of slowly moving, painting over and over 4 times. And then in this section, price moved pretty quickly. It went straight up until it got to this area. And then we start making more balanced price again. So this is extremely important because a lack of balance, an unbalanced or imbalanced area is oftentimes a magnet. These are areas that price loves to return to. It's kind of important for us to understand this because if we want to be in the market and we want to be trading, we want to understand which areas price is most likely to return to. And these are definitely places that are magnetized for price to return, mainly because it's unbalanced. It's the same thing. Think about painting that paintbrush. Well, this area is not going to look good on the wall because it doesn't have enough paint on it. And that means that we're going to need to come back at a later time to put more paint on it. All right, so just keep that part in mind. Now, we've got a couple of different candle looking. We've got a few bearish candles. We've got our nice little green bullish candle right here, and then we move down. So the reason why this is so important is because what happened inside of this area, okay? So you'll notice that here is our gap, right? That's where our gap in price. So price went down, down again, created a gap between the low and the high of these two candles, and then price stopped. Now, remember what we talked about in our last episode. Why did price stop here? That's probably something important to know. Because if price was going down, 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 and then it hit that so-called wall, remember, in this specific area, we're going to want to look left. Right? So always make sure that if you see price pivoting at a specific location, turn left and see what happened at that location. Might give you a better idea of how price is moving within the market. So it comes down and then it goes back up. And then look at what happens right here. Interesting. What price has done is it's come back up and it's taken this area, this singularly painted spot on the wall, and it has repainted on that again. What happened afterward? Right? Price rejects right off of that spot. Because if you were painting, we are done painting in this area, possibly, and now price can continue to move farther away. This is extremely important, okay? Price here was not balanced. It wasn't balanced, right? And so now we're going to see price come back up and then it's going to rebalance this area. So think about this in exactly the same way that we've been discussing when it comes to how these candles are created, right? So what's happening up here? All right, so price goes up and then price goes down and then it closes. And then price goes up and then price goes down and then it closes, right? Price goes up and then it goes down and then it comes back up. And then we get our green candle here, right? And the green candle is going to go up to this spot and boom, finished. And now we can continue on. So what happened? It's like what we talked about initially. We had a spot that only had one candle, one sweep through it, unlike the other parts that had maybe 4 or 5 or more. But what happened over here? As we push through into our new price, now we're seeing 1, 2, 3, 4, 5. We've moved over that spot 5 different times. So what that essentially changes the game to is that now price is balanced, okay? So this is essentially what you want to get comfortable and familiar when it comes to understanding gaps and how gaps are really important locations that we want to focus on. We want to know where they are. We want to see them. We also want to recognize that sometimes price is going to come into this gap and it's going to finish off the painting job. It's going to finish off the balancing act. And once that balancing act is done, it's going to continue on its way. So what we're seeing here now is that, yes, this is essentially what price would be doing, but it's not always exactly what it did considering the time frame. So let's say that this candle right here is a 1-minute candle. So we had 1 minute of price inside of this candle, 1 minute of price inside of this candle. Okay, well, it's possible that price started here, came down, went up to the high, and then closed there, went up, and then came down and closed like this. It's possible that price did something similar to that on a very low time frame. But what would it look like if we were on a higher time frame, because this is really important to understand the difference. Yes, price is fractal. Yes, price does the same thing across the board with different time frames. But it's important to know that when there's more time inside of a candle, there's more opportunities for things to happen that don't just look like the basic up, down, top, bottom, open, high, low, close, open, low, high, close. So if these were, for example, 60-minute candles, and you went inside of the candle to see what exactly happened, you might end up seeing something that looked a little bit more like this. Maybe we started here and we went up, and then we went up again, and then we came down, and then we finally made our low, and then we did a couple of other things, and we went here and there, and then we get up top, and then we stop. And then maybe the next candle, instead of going to that high, open, high, low, close, it actually goes all the way down here, right? And then it comes all the way back up to get its high. Right? And then it does a few other things and some things that maybe you wouldn't even expect price to do, and then finishes open, high, low, close. So it's important to understand that, yes, this could be how price moves, and this is how we explain open, high, low, close, open, low, high, close, but realizing that the more time that's given inside of a candle, the bigger the candle is, the more frequently these types of moves happen. So maybe that affects your gaps, right? Maybe your gaps on a higher time frame actually have a lot going on. They have a lot inside of them. Maybe they're a little bit more balanced than we expect them to be. So that is something that you want to keep in mind. Now, in addition to regular gaps, there are a couple of other types of gaps that are important to take into consideration because you're going to see them in price. So the first one is usually referred to as a volume imbalance. And what that means is, as we said earlier, usually when we get our open, low, high, close, it oftentimes, as we saw earlier, that the close should equal the next open. But what do we see here, right? We don't see the close and the open. Here's the open of this candle up here. So what happened? Well, price jumped, right? Let's say this is a 1-minute candle and this candle ends at 11:59. This candle opens at 12 o'clock. Well, within that milliseconds, price jumped so much that now we have this volume imbalance right in here, okay? So volume imbalances often act a lot like gaps. They are places that price moves very quickly, right? So we should definitely expect price eventually to come back to those, just like the magnet before. Now, also in the same regard, maybe if it is the open of the day or the open of the week, you might see something that looks like this. Well, what exactly happened here? Well, it's not that price wrote over this spot, because at least here we see wick, right? We see some wicks being written across this empty space, but instead we have no wicks in this empty space. So that sometimes you're going to see it as called as a gap in price. So you might see a gap up or a gap down. Sometimes news events will cause this. Oftentimes, if you're looking at the overnight price and futures, when it opens during the day, you might get a jump like this. So just things to understand that these are all different types of gaps. And regardless of what kind of gap we have, whether it is a gap volume imbalance, a gap in price, or just a fair value gap, they're all going to be different types of magnets. So keep that in mind. Most gaps are something you want to keep on your radar, okay? There are a lot of really cool indicators that you can use to already show you these gaps. So they might be a little bit easier, but just start looking at charts and start seeing if you can find gaps and how gaps are being drawn back to, how the price is magnetized towards those gaps. And that will be something that you'll definitely see as useful in your going on with learning to trade the stock market. Now, the second half of this section that we're going to talk about is the Strat, okay? So Strat is really interesting. It's something that was created a little while ago, but essentially it just simplifies how we look at candles. So there are 3 kinds of candles. There's a number 1, which is an inside candle, a number 2, which is an up or a down candle, and a number 3, which is an outside candle. So let's take a look at what all of those look like. So in this instance, we're going to have a 2 down candle, which means we have this bearish candle followed by another candle below. Now, what the most important part you're going to see, this is the low of this candle. All right. Of course, we know this is the high of the candle. The following candle, this one right here, the only side that this candle crossed was the bottom side. Right. So when this candle crossed this low, it became a 2 down. Okay, that's what that created. Now, in the opposite, when this candle crossed there and it did not cross this low, then it became a 2 up. Okay. Now, an inside bar or a 1, which just essentially means that here's your high, here's your low, neither one of them were crossed. If neither one of the high or low is crossed and this candle stays inside of the previous candle, that is now our 1 or inside bar. Vice versa, your 3 or outside bar means that both the high and the low were crossed. Right? You see how this candle, which we also have a terminology that you might see here or there, it's called engulf. So this candle on the right here, this green candle engulfed the previous candle. That is why we would call it an outside bar. Okay. Now, there are some typical structures that is probably good to understand in this strat. And strat is just a beautiful thing because it just shows you something that you can take a little deeper look into when you are watching the market. So there are 3 main reversal structures because a lot of traders like to find a location that's really powerful and trade away from it. They are reversal traders as opposed to a trend trader that wants to see a big trend and jump on the train as it's moving. All right. So there are 3 types. Your first one's going to be your 222. Now, if you notice, here is the bottom of this candle crossing below, not crossing above. So that gives us a 2 down. And then you'll notice another one where we crossed below. That also gives us a 2 down, but we didn't cross here, right? We only crossed at the top. So now we have a 2 up. That would be your 222. This structure is really nice for reversals. Price comes down, but remember, what's really important? Look left, right? So price comes down to this spot and then returns, but there must be a really good reason for price to have bounced off of here. And that's important to keep in mind. Same thing over here, right? Price goes up. We now have a 2 down, or 2 up, excuse me. Then price instead gives an inside bar, right? That's our 1, followed by price crossing the bottom of this one, which will give you a 2 down. Now, great opportunity for reversal. Once again, why should price have stopped right there? Look to the left. Is there a really good reason for price to have stopped here? Did it hit a brick wall and now we're turning around? That is how you can capitalize. I am a big fan of 212. This is one of my favorite reversal structures to trade. Possibly even better than that is a 213. You'll notice we went above this one, but not above or below that spot. So we have a 2 up. Price is inside of the previous. So we have a 1, but you'll notice price went above and below. So this is our 3 candle. A 213 is extremely powerful. Love this candle structure. But regardless, we're looking once again to the left. What could possibly have caused price to stop here in its tracks? And does that mean that we are going to continue going down? Finding another location to reach toward. Okay, so these are just some typical reversal structures. While you're taking a look into your TradingView account, just look across the charts, right? You can find it anywhere. You can find it anywhere you look, right? If I just look at this is simply just an S&P 30-minute. If I can look at this, I can find all kinds of things. I can take a look. For example, we talked today about wicks. We talked about gaps, right? So what does this gap do? Created a huge gap. There's your 2 down, 2 down. That is technically a reversal, 2, 2, 2. But where did price go? Price went here. It filled in this gap. And then you notice, big fall. Right? That's not always going to happen because if you take a look at this gap, what happened over here? Well, went through, continued, right? These are the things that we're going to be looking at. We've got a few different things. You see this candle right here is a 1, right? 2 down and then a 1. This is the open as I talked about. So we've got ourselves a gap in price right here. And as we talked about before, the gaps in price that are oftentimes magnets. Look at what happened in price. Price went up, came down, was magnetized to get into this gap. And look at how perfect. Look at how perfect that is. This is the top of the gap. Perfect, perfect touch, perfect fill of the gap. And then price continues on its way up. Okay, so these are the kind of things that if you come on your TradingView account and you just start looking around, observing, seeing how price reacts to different things. How does price react to the fair value gaps? How does price react at reversals? What kind of structures do I see at reversals? Do I see the 222s? Do I see the 212s or the 213s? Here's a good example of a 223. If you'll notice that price went down, there's your 2, down again, there's another 2, and we crossed underneath the bottom, and then we went above the top. So 2, 2, 3. Another really good reversal structure on the strat. So that's all for episode 4 today. Thank you so much for listening. Please feel free to follow and subscribe, and I'll see you in the next video.